Welcome to our Taking Stock video for the week ending the 26th of July, 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by Equities Analyst Daniel Ortisi to stream to you all things share market. How are you, Dan? Great to have you on board.
Yeah, good to be here, Ken. It's a very busy season now with quarterly updates coming upon us and reporting season right around the corner.
Yeah, it's going to be a lot happening over the next few weeks, Dan, and we'll be presenting together in an upcoming webinar soon as well. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Dan, both the Australian markets and US markets, they were sold down this week as doubts emerge around this AI boom and whether earnings will continue to meet the market's lofty expectations, especially across those magnificent seven stocks in the US. And this risk was evident after both electric vehicle manufacturer Tesla and also Google parent Alphabet, they released second quarter results below market expectations. So these companies are making significant investment into that artificial intelligence theme, but there is now growing skepticism that the costs are outweighing the benefits.
Yeah, that's a very good point, Ken. And we also remind investors that, this risk of complacency in a market driven predominantly by thematics and macroeconomic news rather than company fundamentals and earnings forecasts. So with markets hitting record highs over the last few weeks, we do believe the reward for risk in equities have deteriorated, especially for the remainder of this year, Ken, of course, with earnings risks in the current reporting season.
Yeah, that's going to create a bit of volatility with this reporting season. But speaking about the earnings clarity, Dan, this week we had quite a busy one with a few quarterlies released. We noticed an X-Star stock, a global barometer of the financial markets, Macquarie Group, they were sold down after confirming flat earnings for the first quarter. However, the weakest link in that result was that Macquarie Capital division, with the group struggling to make returns by selling businesses exposed to this energy transition. These issues are contributing to the negative earnings revisions on the stock and was a reason why we ceased coverage on the stock late last year. And within the resources space, Dan, lithium miner Pilbara Minerals, they reported production volumes ahead of expectations, but the market reaction was quite muted. Can you explain why?
Yeah, certainly can. And we talk about sentiment, and that's really driving, the negative reactions to lithium stocks at the moment. And of course, the downward revisions under Golden Rule 3. Even looking at Pilbara specifically under Golden Rule 4, you can see that it's one of the most shorted stocks on the ASX at over 20% of shares outstanding, which is remarkable. In addition, guidance for FY25 was a little bit softer than expected, and this was due to higher forecast operating costs again. Of course, these kind of combination of factors certainly weighed on the share price despite that positive operating result.
Yeah, Dan, you clearly articulated some of these active risks around those lithium markets in your insights article earlier in the year. And with the electric car manufacturer Tesla revealing that growth this year will be notably lower than 2023, I can't help but think that the lithium market will continue to be depressed in the short term.
Yeah, look, I think that's a very good comment, Ken. And lithium prices have been weighed down, firstly by an oversupplied market, but also weaker than expected electrical vehicle sales, and not to mention a slowdown in the renewable energy sector as well, which is important because of energy storage. So much of the increased supply, and we spoke about this in the Insights article, has emerged from China, which is now the third largest producer globally. However, we expect over time that lower prices will help rebalance the market as unprofitable companies cease production and certain projects will not be funded.
Yeah, there's just so many moving parts there, Dan. And due to the challenges of predicting commodity prices in the short to medium term, we have decided to change the way we treat resource stocks within our star stock portfolios. Although resources can aid in portfolio diversification, our research does suggest that the contribution to the outperformance or returns over the long term is statistically insignificant, with commodity cycles over time offsetting each other. However, for our members, we aim to cover resources within a separate category and focus on the most relevant producers in their unique sectors.
Yeah, and investing in resources absolutely is a challenge, isn't it, Kian? And
Mm.
we've decided to remove small tier gold producer Alkane Resources from the Star Growth Stock universe. Even though the gold price has strengthened over the year, this has not translated to Alkane's share price due to its small size and scale, along with certain operational delays. It's another reminder that investing in gold miners is very different from investing in the gold price itself, Ken. Specifically to this stock, we can see the negative earnings revisions and obviously growth forecasts under Golden Rule 3, highlighting what I've just mentioned. But we remain favorable on the gold thematic in the near term and remain to have exposure throughout our coverage in stocks like Perseus Mining, Gold Road Resources, and Capricorn Metals as well.
Yeah, speaking about some of those stocks, other miners to report their quarterlies this week were Mineral Resources and also the gold producers you just mentioned, Capricorn Metals. But please read our analyst commentary for further details. But moving away from resources onto property, Dan, during the week, we had childcare property owner Arena REIT. They announced a small equity raising to fund acquisitions of around 6 early learning centres and further developments of 4 early learning centres worth a total of 92 million, which also helped them pay down some of the debt on their balance sheet as well. But Dan, how will this impact their future dividends?
Yeah, it's a very pertinent question, given it is a star income stock, Ken. And at current interest rates, the raise is a slight dilution in overall shareholder value for non-participating shareholders. So for those shareholders who haven't taken up their share purchase plan, we guess that management's rationale is when the interest rate cycle starts to come down, these acquisitions will increase in value over time. And positively, management actually expect to deliver around 5% dividend growth in FY25. So we can see that the dividends relatively unaffected by that acquisition in the short term. And further on, future developments will start to contribute to rental income as well.
Yeah, so to summarize here, Dan, this should continue to support its dividend payments with a dividend yield currently around 4.6%. Note that the payout ratio for REITs, especially here, is 100% because REITs tend to distribute most of their operating income to shareholders.
And looking ahead at the corporate calendar for this weekend, we are anticipating ResMed to release its annual result, which is highly topical given the impact of the GLP-1 drugs
Mm.
that the stock has experienced. So we'll definitely have a very close eye on Stargrowth stock ResMed.
This week, in Under the Microscope, we take a closer look at large cap player in the energy sector, Woodside Energy. The code is WDS. Now, Dan, Woodside provided a quarterly update this week, and the share price reaction was rather muted. So, what did we learn from the results?
Well, Kian, much of the market's focus was actually on Woodside's recent announcement to acquire a North American natural gas company called Tellurian for about Aussie $1.3 billion. The deal provides Woodside with a future growth option in the US LNG market. And in terms of the quarterly results, production was a little bit soft due to some planned and unplanned outages at its producing hubs, as well as weaker than expected LNG prices.
So, Dan, it was a less than spectacular result then. I noticed that earnings growth for financial year 24 and moving on to this year, financial year 25, is still expected to be negative. So, what's contributing to this?
Yeah, good question, Kian. And members familiar with Woodside will recall that the company sold a 15% stake in its Scarsborough project to Japanese utility company JERA. Now, this sale did free up around $1.4 billion of capital, but it did reduce future production volumes, leading to lower future earnings. Furthermore, the outages in Q2 2024, or the report that we just passed, also negatively impacted earnings revisions, Ken.
Well, that explains it, Dan. But circling back to that Tellurian acquisition now, did management provide any strategic rationale for the purchase? And how would this impact the company from an earnings perspective?
Yeah, management believes that the purchase aligns with the company's strategy, Ken, by adding scale and diversity to its global LNG portfolio. So, for example, the Driftwood LNG project, which is owned by Tellurian, has development approval for up to 27 million tonnes of LNG a year in exports, which is almost 3 times Woodside's current output from its Australian projects. So from an outlook perspective, its near-term earnings contribution, of course, is limited as the project is in development and will take quite a long time to head into production. But this, of course, also depends on an updated economic study. The acquisition could improve return on invested capital over time, Kien, if it is deemed accretive.
Well, that looks like there's some great growth prospects there, Dan. And I noticed that the company is in satisfactory financial health with its balance sheet ratios quite elevated, though. How would this transaction impact the solvency risk of the business?
Well, Woodside, of course, needs to inject a substantial amount of capital to bring this new project to life, but it
Mm.
has sufficient capital from recent asset sales, as we've mentioned, to fund this current acquisition without taking on additional debt. Of course, as we mentioned, it's about a $1.3 billion purchase price, which is relatively small compared to the size of Woodside. So we do not believe its current impact to the financial health of the business will be material.
All right, and financial health should remain intact then. What about Woodside's dividend yield? It looks rather attractive, currently at around 9% grossed up. Dan, should investors consider this stock for income?
Yeah, we actually had a chat about this, Ken, didn't we? And, it was kind of thrown around that if Woodside didn't make that bid for Tellurian, the recent sell down of Scarborough could release some capital and support higher dividend distributions. However, given that significant growth in the near term for Woodside, income investors might be cautious. Also, especially given that, as we can see, free cash flow is currently below the forecast dividend payment. So we will get more information regarding its income plans, Ken, this reporting season.
Now, with the reporting season fast approaching, Dan, a useful question this week is how can Stock Doctor help me keep track of those stock announcements and also those updates?
Well, Ken, with so many companies set to report the results over the next 2 months, it can be difficult to keep track of everything, but Stock Doctor does make it quite easy. First and foremost, ensure that your portfolios are up to date within the portfolio manager. Then you can set up alerts to monitor stock announcements and changes to the stock fundamentals.
Yeah, this is quite useful to set up those alerts. You navigate to the alert manager under the tools, then create a new alert and enter the company code and select from 4 alert categories with some key ones, including you've got star stock changes. You can also select financial health rating changes, earnings revisions here. I like the price sensitive announcements as well, and days until ex-dividend if you're income focused. And of course, there's also the technical triggers like the SD30 TSR. And these alerts can be processed intraday and you can be notified within Stock Doctor or via email. It's really your choice.
And aside from the alert manager, Ken, there's also, of course, the corporate calendar, which provides a window into companies expected to report. But just be mindful here, as if there is an asterisk next to the stock code, it means that the date has not been confirmed with the company and is estimated by our system based on last year's report.
Yeah, and at the individual stock level as well, you can also access the upcoming corporate events by clicking on the date item at the top of the 9 Golden Rules page here. You can also see a list of alerts and whether this stock is in your watch list or your portfolio.
And last but not least, of course, Kian, is that reporting season is when our financial health model really shines. So it allows our members to quickly conduct due diligence on a company after the release of its results. So no other financial health model out there has been back tested, of course, with a 96% success rate in helping investors avoid those corporate failures.
Yeah, so those results will be coming out and financials will be coming out quite quickly this reporting season. So stay tuned for that. But these tools will help you stay on top of your portfolio. And as always, feel free to contact us if you need any assistance. Also, be mindful that the research team will be extra busy analyzing the results, but we will endeavor to return your call in a timely manner. That's all we have time for today, Dan. And again, thanks for your contributions. It's going to be a busy one over the next few weeks.
Absolutely, Ken. It was a great episode today. And of course, if any of our members do have further questions with today's episode, feel free to participate in the Lincoln Live session this coming Monday.
And also, if you know any family or friends who you think will benefit from Stock Doctor, we would appreciate your referral. Remember, our business is driven by our members, and we appreciate your ongoing support and loyalty. In the meantime, have a happy, healthy, and prosperous week ahead.